You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, so last week we talked about a little company called ROKU. It was an interesting scenario and probably one of the better learning scenarios that we can get with ROKU. I've kind of been on the long straddle and different versions of long straddles recently, and it's mainly because the market's been a little bit crazy all over this year, and I mentioned it a little bit on last week's call. If you were to just look at what the market has done relative, if you were buyers of options on most of your strategies where you were net long premium, you should have done better than sellers of options. And a lot of people always have this big misnomer in the options marketplace that you have to sell options to make money. It's not always the case. When the market's more volatile than what the marketplace is implying, in hindsight, it's usually better to just be buying options as opposed to be selling them. So we talked about quite a few straddles and a couple of companies. One of them, one of the bigger ones that we've talked about is Boeing, and Boeing made a huge move this week again. They're finally talking about the fact that the planes could fly in early 2020. So that stock has rocked, but the stock specifically that we looked at last week, I promised you that I was going to follow up on the call. We looked at a long straddle in ROKU, and what we discerned was that we wouldn't want to do the long straddle before earnings because ROKU just in general is just such a volatile stock, and there's a lot of competition that's coming in. There's a lot of stuff that's going on with the streaming services. There's a lot of stuff that's going on with the cable companies that are, quote-unquote, threatening to provide the same type of service that ROKU does via a box, something similar to like an Apple TV or a Google Chromecast. The cable companies are coming up with their own, and a lot of people took that as, well, that's bad for ROKU, and the stock went down. Then they announced earnings. And so a lot has happened in the underlying stock. And here's what we mentioned. We said, okay, we're going to look at ROKU. The stock's been extremely volatile. A lot of news is going on, a lot of information going on just in the space in general. And on the day they were going to announce earnings, the market was closed. We taped Options Playbook Radio on November 6th. The quote that I have was right around 4:30, after 4:30 Eastern time, which means the markets were closed. And ROKU on that day, using that day's closing prices on the options contract, the last trade was 141.05. It was up $1.48 on the day. And so we looked at the 141 straddle, just as a point of reference. And I like to do this because it just shows you how much implied volatility and known events really affect the option prices. So if we look at buying the 141 put and at the same time buying the 141 call, that's considered a long straddle inside the options playbook. That was trading for $19.90, and we just kind of rounded up and said, well, the midpoint's somewhere right around $20. What does that imply? Implies after earnings that the stock could move approximately $20. And the best way that I can think to describe it is you're really saying the over-under as far as what the earnings might do to the stock price. Now, it never is in regards to the direction. It never says, well, $20 to the upside, $20 to the downside. It's just saying, in general, after the announcement, the stock could move approximately 20 points. So what I'd said on the call was, let's look at that, keep that in mind, keep that number in our head. And if I was going to do a ROKU trade, just because I don't think the volatility is going to stop just because of the earnings, I would wait until they announced earnings, let the implied volatilities come down, and then think about doing a ROKU trade. And so in this instance, I said I'd try to take a quote somewhere around noon. The stock actually opened down exactly 20 points, almost exactly, like almost to the penny, which is always interesting to me how when that happens based off of what the long straddle was at. And then I just let the stock trade, and then I watched it, and I went and I looked at the stock, and the quote on my Ally Invest multi-leg quote box said that it was about 1123. So at that point in time, the stock had came back a little bit. ROKU was trading at 127.62. It was down $13.43, a little less than $20, so it made a little bit of a bounce back. And the midpoint of the long straddle, at the most at-the-money long straddle, was trading for $8.85. So, exact same expiration. As a matter of fact, 1 day has now gone away, and you're looking at the long straddle before earnings was trading at $20. Now the long straddle, everything being equal, basically right at the money once again, is now trading for $7. So you're talking about $13 difference between buying a long straddle the moment before earnings and buying the long straddle 3 hours or 4 hours after the earnings have been announced. So what I found was very interesting about it is the volatility did continue. And if you look at the chart on that day, it opened up about down approximately that $20 that I mentioned, came rallying back, went to about 128 when I took this long straddle quote, and then almost instantly the stock went back down more than $25. So just real interesting trading. So you got almost more volatility after all the volatility premium came out, which is just odd to me, but that's sometimes happens. And almost 99% of the time after earnings get announced, you end up seeing the underlying stock become more volatile, but you still see volatility come in. You still see that crunch come in. So on that day after they announced earnings, the stock officially opened, according to the Ally Invest charts, at 118.75. The low was down to 116.26. The high was 128.38, and then it ended up closing 10 points below that at 118.46. So there were many points if you would have actually did that long straddle on that day, based off of that quote, that trade would have been profitable. And once again, in ROKU, it's just I would rather, if I have a stock that's extremely volatile just overall and there's a bunch of news out there, I would rather do the straddle after a big event than put the straddle on before. And what I would have looked at doing in ROKU is not doing the 2-day straddle, which was $7. I would have went out 15 to 20 days, maybe even 30 days in time, and looked at what the long straddle was trading at there. So interesting trade, interesting dynamics. I always like to point out how big of a volatility crunch, what volatility crunch is after earnings, why that term even exists, And here was a great example. ROKU trading for 20, at most at-the-money option contracts. Before they announce earnings, stock goes down. It's as volatile as the expected move is saying, but volatility still comes in and is trading for $7 for the most at-the-money straddle in that same expiration with one less day remaining in the trading. And that expiration that we were looking at was November 8th, which means that would be done trading. Last week it would have been done. The expiration was on that Friday, the 8th. Okay, so let's stay in the same space. And I want to back away a little bit. And I want to talk about a strategy that I coined the term inside the options playbook as the fig leaf. And the fig leaf is just an alternative to a covered call. It's one of the more popular strategies that I've seen in my career of teaching options over the last 20 years, but it never had a name. So the more, I guess, textbook name would be a leveraged covered call, in that we're going to buy an in-the-money, longer-term option, and that option is going to basically act as a surrogate for our underlying stock, and then we'll sell a short-term call against it. Hence, it looks a lot like a covered call, because you're going to go deep into money. You're going to have an option contract that acts a lot like the stock or represents a lot of the stock price movement. We're going to look at like an 80 delta or even more, and then we'll sell a short-term call against it. And Disney just recently has been in the news a lot, and they just came out with their streaming service called Disney Plus, and they also recently announced earnings. So today we are taping Options Playbook Radio. It is Wednesday. It is the 13th. The markets are actually open at this point in time. And we have Disney last trade at $145.52. It's up $6.94 on the day. And we're going to go out and do a fig leaf on Disney. So we're going to go all the way out to June of 2020. The normal monthly expiration in June is June 19th. That's the third Friday. And we're going to go deep into money. We're going to be looking for an 80 delta. And in order to get an 80 delta, we got to go down to the 130 strike call. So the stock's at 145.52. The stock surrogate, if you will, that we're going to buy is going to be a deep in the money leap with a June 19th expiration, 130 call. That option contract is trading right now at $19.90 by 21. That is the dollar amount. Now you think about this. So if I paid the ask on that, it's only a 10-cent wide spread, which isn't bad for leaps. It's one of the things about leaps that kind of scares you away a little bit is sometimes they'll have wider bid-ask spread, 25, 50 cents, and then that just makes it a little bit less feasible to actually be buying that option as a replacement for the stock. But you think about this. Disney right now is trading at 145.52. If you want to buy 100 shares of that stock, you're going to have to put up $14,552. As opposed to that, we're going to get 80% of the stock price movement. We're going to get that type of representation, and we're only going to put up $2,100, $2,100, which is the asking price of the June 19th, 2020 put. And granted, it still has an expiration date, but we're going out 219 days. That's when the June 19th option contracts expire. And then we're going to sell a short-term call against it. We're going to help try to pay for a little bit of the time premium that we got to pay in the longer-term option. It is a long-term option contract, so you still have some time value that you're buying and that you're paying and that could decay over time. So we're going to sell a short-term call against it. So right now, I want to give myself a little bit of upside. It's just ran 7 points. So we're going to look at the 150 call on the November 29th expiration. So if we look at the 150 call on the November 29th expiration, that has 16 days until that option contract would expire. And my whole goal, the biggest thing about doing a fig leaf relative to a covered call is we call it a fig leaf because you're kind of covered. You don't own 100 shares of stock. You own something that acts like it. So you'd have to do something if you were assigned on the trade. In other words, if the stock does go above 150, which is our strike price, before that expiration date, you really want to avoid being assigned on it because you're just trying to bring in the premium. And that's the main thing that you're looking to do here is just get the premium. And as opposed to a covered call where you might actually really want to sell the shares if it goes that much higher. It's a little bit of a different approach to the concept of covered call writing, I guess. So 130 strike call, June 19th expiration, asking $21. We're going to sell the 150 call, November 9th expiration, 16 days away. And right now it's bidding 144 and it's asking 150. So let's just say we could sell it closer to the 144. The midpoint on this trade, if we entered this all as a spread down on the trading floor, we could fill this approximately at the midpoint. This is a live market quote right now. It's trading at about $19. Now, never meant to be a recommendation. These are just learning scenarios, just like we talked about ROKU, which was an awesome learning scenario last week. We're going to look at this type of trade. Why are we looking at a fig leaf? Well, if you're a little bit long-term bullish because Disney's been in the news, you kind of like this. It's an expensive underlying stock. Some people don't want to spend $14,000 to buy 100 shares, and you have to buy 100 shares. If you want to do a covered call on the situation, you can't buy 50 shares. You got to buy 100. And this is an interesting alternative to that covered call. They've already announced earnings. We're not quite as worried about the volatility. We're going to go out longer term. We're going to pay $21, which if you do the math, that's about 13% of the total cost. $2,100 is 13% of $14,552. So you're not even putting up what you would have to on margin to buy the stock if you actually just bought 50 shares and margin the other 50 shares. So you're putting up less than half of the total value like you would have to on margin, and yet you can still sell a call against it, and once again, you're kind of covered. That's why we come up with the name of fig leaf. So if you do this trade, one of the things you have to be aware of, if the stock gets to 150, you got to do something. You don't want to exercise your long call to get the shares, and the reason why is the long option contract is still going to have some time premium in it. If you exercise that long option contract, you're going to be giving up whatever time value there is left in the June 19th call. So, a couple of things. If you do it inside the options playbook, we actually have a managing positions tab, which is on the Options Playbook website, and there's a section called Rolling a Covered Call, and you'd want to read that and study it and make sure that you're applying those themes for rolling a covered call. It's also inside the playbook in the back section, in the appendix area, and you could, if you have a hard copy of the playbook, you read this, but this would be required reading if you're thinking about doing a fig leaf. Because if the stock gets to that 150, you got to do something, and you want to set an alert for that price. If not, well, heck, you brought in $1.50 on a $21. Well, it was $1.44, but we're going to call it $1.50 on a $21 underlying, if you will, or $2,100. You're bringing in 7% of the total cost of that leap by selling one call option that's 16 days out. So it's just a very interesting trade. I always like to talk about fig leaves. It's a little bit more on the boring side, but I think boring in investing sometimes can be good. So that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.